Okay, so today we're talking about 1031 exchanges. Easiest way to explain this is with an example. So let's say I've got a property that I purchased a long time ago and my cost basis in that property is $100,000. I'm ready to sell it or liquidate it and basically move on to a new property in my real estate portfolio. So market value is around $150,000. So I can sell this property for 150 grand, but I'm thinking, crap, I don't want to pay tax on $50,000 in gains because that's going to be pretty painful. So what I do instead is I identify a similar property. The IRS is super loose with this definition, surprisingly. Basically, like I can swap a single family residence for a commercial building or for a big apartment complex, something like that. So I identify a similar type of property. I have to identify the new property that I'm selling within 45 days of the closing of my first property, of the sale of the first property. And then I have to close on that new property within 180 days. And so those are kind of the two time constraints that are involved with this. But basically what it allows me to do is say, okay, rather than paying tax on $50,000 of gain, buying a new property for 150, and then starting my depreciation cycle over with $150,000 basis in the new property, I instead basically just get to say, no, my basis in the property is still 100 grand, even though I now own $150,000. So I've just kicked the can down the road on my gain calculation. And then I just continue depreciating basically the new property as if I only paid $100,000 for it. So a couple of important things and misconceptions. Number one, you have to involve an intermediary. This is like a person that actually takes the proceeds from the sale of your first property, holds on to it until you close on the sale or on the purchase of your new property, and they facilitate the whole transaction. If you touch the money, it's over. You basically kind of dissolve your ability to do a 1031 exchange. So it's super important to involve experts that actually know what they're doing with this. You can't just say that you did a 1031 exchange because it's not allowed. So that's the other important thing. And then outside of that, the other kind of planning perspective from all of this is that it's a great estate planning technique. So if I, for example, do this over and over throughout my real estate career, and let's say I started with that $100,000 property and I end my career at, I've got $1 million property. I haven't paid a dime in tax on any of those gains. And then basically, if I die with that property, my heirs get to inherit it as if they paid $1 million for it. So that's called a step up in basis. If I die with something that's worth $1 million and I haven't paid tax on any of that gain, tax laws don't require that the heirs get punished for my, not paying tax on any of it throughout my career. So they inherit it pretty much tax-free. You can just turn around and liquidate the property, and then they don't have to have any tax implications. This is a strategy called buy, borrow, die. Super common for estate planning. It basically says buy something, let it appreciate in value, leverage it, so borrow money against it, go to the bank and say, I need money, here's the asset that can back up the loan. You can live off of the loan, and then you die and your heirs get to inherit that. You've never really paid any tax on it. So this is the strategy that's super common among like really rich folks. You'll see like Elon Musk or Jeff Bezos in those years that they're not paying any money in taxes. That's what they're doing. They've got a stock in a publicly traded company. They go to the bank and they say, I've got this thing, it's worth a ton of money, loan me some money. And they do. They live off of that. They don't technically have any taxable income because they haven't sold the asset. That's kind of what you're doing here, is you're technically selling it, but for tax purposes, if you do a 1031 exchange, you're not selling it for tax purposes. You're doing an exchange and basically kicking the can down the road and doing some tax deferral. So great strategy if you do it correctly. If you have questions about how to do it, let me know.